Hello and good morning. Why does my camera look like that? It looks a little strange. I hope I'm clear on your side. But we are here to talk about home loans, guys. We're going to spend another 3 minutes covering topics about home loans. And today we are going to talk about down payment assistance programs. Okay. Down payment assistance programs. So for any of you that have questions, comments, concerns, or want me to cover anything that I'm discussing, maybe rehash it, throw it in the chat box. Please let me know anything that's on your mind, even if it is off topic. But like I said, today we are going to talk about down payment assistance programs. For any of you that have questions that want to have one-on-one conversations, that's awesome. That's amazing. I encourage that. Phone number is right there in the chat box. I just put it. So you can call that number. You can text that number. We can have a one-on-one personal conversation. We can have a text conversation. Lots of different ways to solve this, but let's get right into it. Let's talk about down payment assistance programs. What are they? What are they for? How do they work? Where do you go to get them? Who do I talk to? This whole process is so crazy. So it's real simple, guys. So loan officers, which is the job that I have, mortgage loan officer, MLO, NMLS license 1066958 for disclosure reasons. What we do is depending on our level of experience, we get exposed to different products, different tools. Depending on our level of desire to learn, we're able to help people with those products and those tools. So it's kind of like a doctor, okay? So you could have just graduated medical school and you are a doctor. Or you could have leaned into neurosurgery or podiatry or whatever, heart surgery, whatever the specialty is for the last 30 years, and you're still a doctor. So when it comes to a loan officer, same thing. So you might be really good at doing one type of loan, FHA, but you might not know how to do VA, or you might not know how to do conventional, or you might not know how to do down payment assistance programs. Well, here's the good news, guys. You're dealing with tippy top of the food chain when it comes to loan officers. So we have it all dialed in. Okay, we have it all dialed in. So who you work with is a big deal because they may or may not be well versed in the products that you're talking about. And there are some really honest loan officers out there that'll go, that's not my area of expertise. Go talk to that guy. I know he's really good at it. So some loan officers do that. But for the most part, you'll come to them and go, I want down payment assistance. And that new, unexperienced loan officer might go, okay, let's do it. And then God forbid that you get into contract and you don't close because you were improperly qualified. God forbid, because that happens all the time. We get so many calls from other real estate agents going, hey, you think you can save this? And sometimes we can. Most of the time we can. Sometimes we can't. But most of the time we can because we know how to work the file and move things around. And are able to talk to our clients to figure out why certain things have popped up so that we can communicate it to the underwriter so that it makes sense. But I digress. Let's talk about the programs. Okay, so here's what it is. Every loan program that is not VA and not USDA requires a minimum down payment, okay? For conventional, 5%, unless you're a first-time home buyer, you can go down to 3%. For FHA, 3.5%. Okay. And for conventional, that number changes. It goes from 3%, 5, 10, 15, 20, 25, 30, as much as you want to put down. Once you hit 20%, the mortgage insurance goes away, but then you put as much as you want. But as far as the minimum, that's what's required. Okay. So the bank says, we're going to lend you $500,000. We're going to lend you $500,000. But you need to put your 3% in, $15,000, to show that you're serious. And if you can do that, that's meeting the guideline. As long as your credit's in line and your income's in line, we'll lend you the rest of the money. So $500,000 minus $15,000, that's $485,000 that they're going to lend you. You bought a $500,000 house. All you had to do was come up with is that $15,000, and they're going to lend you $485,000. So that's a pretty damn good deal, if you ask me. Pretty damn good deal. But I know what it's like living in this world today. I know how much gas costs. I know how much food costs. I know how much rent is. I know how much it is to raise children. So how on earth do you save $15,000? If you're lucky, You've had parents that have taught you discipline, and they've taught you to put money away for a rainy day, or don't touch it, or a fund to maybe one day buy a house or a car or whatever it may be. So if you're lucky, you got taught discipline, and early on you were able to put a little bit away, and that little bit away adds up pretty darn fast, guys. Pretty darn fast. Just think about it. The COVID was 6 years ago. 6 years ago. Okay. Like a blink went by like that. Okay. So if you started saving, let's just say, I don't know, $300 a month. Okay. Since then, that's $3,600 a year. That's $18,000 that you would have saved since then. Okay. So you would have had your down payment. So discipline's a big deal. But what if you weren't taught that? Or what if, literally every dollar that you bring in gets spent? Okay. Maybe you are able to save a couple thousand here, a couple thousand there because of income taxes. Let's say you get your income taxes and you got $3,000 and you're like, okay, I have three. And then the next year you do it again. Maybe you get $3,500 and you're like, okay, I have $6,500 in my hand now. Okay. But I don't want to wait 2 more years or not 2 more years, 3 more years of doing this to buy a house. I want to buy a house today. And that's why the down payment assistance programs exist. They exist because maybe you do have a good income. Maybe you do have good credit. Maybe you just can't save the money because life is so expensive, but you want to become a homeowner, and you probably can, and you will be able to make that mortgage payment, but saving that 15 G's is a pain in the butt. Okay, so that's why these programs exist, is because the banks want to lend money. Loan officers want to do loans. Realtors want to sell houses. Escrow wants to help with the transaction. So everybody that's involved has a motivating factor. So how do we get the borrower from A to Z if they're unable to cross this bridge of saving money? Down payment assistance program. So the first thing people ask is, okay, Chris, you've told us all that already. I'm on the fence, or I'm not on the fence. I'm leaning in, listening to you. I want to know the data of what it takes to get this program. How do I get that $15,000? How do I get this bridge to cross so I can become a homeowner? Okay, 2 things. Really simple, really easy. Okay. Down payment assistance programs, for the most part, start at about $620, but only a couple programs open up at $620. Then $640 is your next milestone, and this is the biggest milestone because it opens up a whole array of down payment assistance programs. And then at $660, it opens up all of them. So what that means is, if you want to talk about down payment assistance programs, you need to have a 620 or better credit score. If you want access to most of the programs, 640 or better credit score. If you want all of them, 660 or better. Okay. But if you were to ask me, hey, Chris, I'm working on my credit and trying to get the scores up. What score do you want me at? Where would you want to be at? And I would say 640 or better. 640 or better, because that's going to open up a lot of programs. You're probably going to qualify for one of them, and it's going to make sense for you and your family. Okay, so that's what I would say. 640 or better credit score is the target. But once again, if you have 620 or better, we do have programs that we can plug you into. Now, what it's going to do, because it's not going to give you the money for free. It's not just like, here's $15,000. Congratulations, you 640 credit score. And by the way, the program, never mind. So they're not just going to be like, take my money. It's free. It's not that at all. It could be one of 2 things, okay? It's either a grant, which is free money, providing, there's always a catch, right? Always a catch. Providing you live in the house for 3 years or more, okay? So they'll give you a grant. They'll say, here's $15,000, but you have to live in the house for, let's just say, 3 years, okay? You have to live in the house for 3 years. And if you do that and you accomplish it, we're going to call the money forgiven, which means you don't owe a dime. You don't have to pay it back. 3 years. Now, I know what your question is. What if I sell my house before that 3 years? Well, guess what, Billy? You're paying that money back. Every single dime of it. And it does have a tiny interest rate attached to it sometimes. So that tiny interest rate must get paid back too. So you might be paying back $15,400 or something like that. Okay. And yeah, when you sell your house, it'll get paid back. And you're like, well, Chris, what if rates go down drastically in the next year and I want to refinance and get that better interest rate? Yeah, you're going to pay it back. You're going to pay it back. If you don't live in the house for that 3-year period or whatever the period is for the program, you're going to pay that money back. Now, the good news is most programs have a step down provision, which means for the first year, they forgive $5,000. For the second year, they forgive $10,000. And for the third year, they'll forgive the whole $15,000. Okay. So 2 years in, you only owe $5,000. 1 year in, you only owe $10,000. Inside of 1 year, you're paying back to $15,000. So some programs have that too. So that's good news. So it's not an all bad situation. Okay. So once again, I say this every time in finances, there's no good, no bad, no right, no wrong. It's either appropriate for you or not appropriate for you. Which category are you in? So that's how you really want to look at it. So yeah, that'll happen. The other one is called a silent second. So what is a silent second? So they're going to give you $15,000 for the down payment. Okay. That is a second loan. Your first loan is the $485,000 that you borrowed, and then put those together, $500,000. Same scenario, okay? So the first loan you're going to make a mortgage payment on, okay? It's not silent because it's like, hey, it's the first of the month, pay me, okay? So it's not silent, it's screaming at you every single month, pay your mortgage, okay? And then the other one doesn't do that. It doesn't show up at all. It doesn't, you forget that it's there because it's silent. You don't have to make a mortgage payment on it, okay? And it does become due and payable in your loan terms eventually, but that's down the road. So you don't have to worry about making a payment on that early. But if you do want to sell your house somewhere down the road, it is payable. I mean, not payable, it's due. You have to pay it, okay? You have to pay it. Now, some people are like, why would I choose that over the grant when I could just live there for 3 years? There's pros and cons to every program, guys. Pros and cons to every program. There's a lot of reasons why you wouldn't choose the grant. There's a lot of reasons why you would choose the grant. So there's not, but once again, it's not right or wrong, good or bad. It's either appropriate for you or not appropriate for you. And being totally honest, the down payment assistance program in itself, even if you qualify and you can get it, not always the best program for you, not always. But for those where it makes a difference between them becoming a homeowner and not becoming a homeowner, I freaking love them. Especially with the fact that you're not going that deep and borrowing that much money to buy a house. Because home values, they jump up pretty darn fast, guys. Pretty darn fast. I mean, just think about it. Let's say you bought your house 10 years ago. Okay, let's say you bought your house 10 years ago for $300,000. What's it worth today? 360,000, 400,000, $500,000. Every single one of those numbers is a lot of money. Every single one of those numbers. So let's say it went by 10 years and you made $60,000. Well, that's more than enough money to pay back the money that you borrowed for the silent second. More than enough money. So all you had to do was live in the house, make your mortgage payment, and it's going to pay everything off for you. Okay. And how you would accomplish that is through a refinance. So when you do a refinance, you're redoing the loan. You access that equity to pay off the debt, so it never really came out of your pocket. And depending on interest rates, if we do this correctly, your mortgage payment could be the same or less than you were paying before you paid it off. So lots of different strategies and ways to solve this, guys. And the reason why this is top of mind right now is because I just had this conversation last night with our new clients who we just got qualified for a down payment assistance program. Let me tell you about their program. Okay, let me tell you about their program. I am located in California. Our bank is licensed in all 50 states, so we can help you in any state. And every state has different programs, and we have programs that are in every state too. So what that means is regardless of where you're at, we can help you. I'm just telling you about a California-specific program right now. It's called the Cal HFA. We say Cal HAFA, okay? Cal HFA. Now, Cal HAFA has a pretty interesting program going on right now called the California Dream for All. And this program will lend you 20% down up to $150,000, okay, to buy a house. You'll get that much money. So what that means is if you're buying a $500,000 house, 20% down, that's $100,000 they can give you to buy that house, okay? Now, Here's where it gets tricky for some. These particular clients that I'm talking about right now, this is why it got tricky for them, is they qualified for the program. They met the income limits, that everything just made sense. But for some reason, they couldn't wrap their head around how they're going to be able to get out from underneath this, because this particular program has what they call shared appreciation, which means, let's say you buy your house for $300,000 and now it went up to $500,000. That difference is called equity. That $200,000 difference is called equity. And a lot of people go, wow, when I sell this house, I'm going to take that $200,000. That's mine. Put it into a new house, do whatever you want with it. It's your money, minus fees and taxes and stuff like that. But with California, you got to share some of that $200,000 with them. Now, with that $200,000, you would pay back that $100,000, and then you would share the remaining $100,000. So $200,000. Remember, they give you $100,000 to get in. Boom, $100,000 is already paid back to them. The second $100,000 you have to share with them. Okay, you have to share it with them. You might walk away with $80,000, $50,000. I don't know. It depends on your scenario. But that's where they couldn't wrap their head around it. And they're like, so interest rates today are, let's call it 6%. Okay, they're at 6% today. And they have not been coming down fast at all, guys. So they went all the way up to about 8% in 2022. And we're at about 6 right now, 6 to 6.5. So we've gone down a point and a half, maybe 2 points for some in the last 5 years. That's insane. So rates aren't coming down fast. So they're like, all right, so we get this program, and the first thing we want to do is strategize to get out of it, because we don't want to be business partners with California forever. We want to get in and get out as fast as possible so that we can start building a life and have an idea of what our future looks like with our retirement, right? But how can you do that when California is your business partner on a real estate transaction, right? So $100,000 is a lot of money. $150,000 is a lot of money. And you can get that. And it'll help you with the down payment. It'll help you with closing costs. It'll help you with so much. And it may be the difference between you buying a house and not buying a house. Okay. So I'm not dogging on the program at all. I'm talking about this particular client that was very confused about it. So when they talked to me, they're like, yeah, the loan officer was really cool up front at the very beginning. And then they kind of started ghosting us and not answering our calls. And by today, we don't really have a open communication with them. They're like, so will you help us? And I'm like, yeah, absolutely. I'll help you. Absolutely. I'm well-versed in the Dream for All, and I'm well-versed with CalHalfa. And I said, look, you don't seem to be a fan of the Dream for All program. And I understand why. And I explained it to them. Here's how I see it. And they're like, yes, Chris, that's exactly how we see it too. We're going to be business partners with California. We don't know how we're going to be able to get out. And this doesn't seem realistic. And I'm like, okay, cool. So I told them this. Here's some good news. CalHalfa is a wonderful program. It's a wonderful program. The Dream for All isn't the only program that Cal HFA offers. There are others. And I said, I'll tell you what I'll do is I'm going to get you qualified traditional with you paying the down payment. I know you don't have the full down payment, but I want to give you the scenario so you can look at it. Then I qualified them for CalHalfa with just the down payment, just covering the down payment. Okay. So traditional, meaning they're paying down payment and closing costs. Or if the closing costs can be negotiated, awesome. The second option, they're paying or they're getting the down payment covered with the closing costs being negotiated, optional. And then I give them one more option. The last option I gave them was down payment being covered through the CalHalfa program, closing costs tied to it. So majority of the closing costs will be covered. Okay. So all they have is this little tiny balance left over, call it, I think it was $5,000, okay, that could be negotiated to be paid, which means if the agent's able to negotiate that $5,000, the buyer gets in with no money out of pocket. No money out of pocket, okay? That total amount of money that they'd be borrowing, if I remember correctly, it was like $30,000, $30,000, okay? Now, let's go back to the scenario that I just gave you a few minutes ago, where you bought your house for $3,000, $300,000. Maybe it's worth $360,000, $400,000, $500,000. Okay, those numbers are really realistic to get to. And in that scenario, I can see down the road where they could potentially get out and pay that $30,000 off be on their own with their own mortgage and then plan for their future and their retirement. And I explained it to them. I said, here's how I see it. Now, I could be off because we don't know when interest rates are really coming down. We don't know when we're going to have a real estate boom, but I did it based on historical factors, okay? Not your anomalies, okay? Not your anomalies. 2020, 2021, during that time, that was an anomaly. We really can't factor that. A lot of people made a lot of equity really fast during those times because of bidding wars and stuff like that, so we can't base it on that. But I told them, here's how I see your California Dream for All program with the total numbers and the ability to pay it off. And here's how I see this current program where you're borrowing way less money. You do have a larger mortgage payment because you're borrowing more money, but here's how I see how you get out of this one. And then I said, do you understand both? They were like, well, we have a question about this. Cool. So we went back and forth on a few questions, and I'm like, cool. Any more questions? They're like, no, Chris, we got this now. We totally understand this. And we're going to go with the options that you newly presented us, where you're covering the down payment and most of the closing costs, because that makes the most sense for us, keeps money in our pocket today, allows us to get in. And then I see it being very realistic to pay back that debt in a very reasonable amount of time. And I said, that's how I see it too. That's how I see it too. See, let's go back to the very beginning of our conversation. Some loan officers know how to do a lot of things. Some don't. So this particular loan officer that helped them at the beginning, I would have thought would have gone over a couple more Cal HAFA programs with them. They were already doing the California Dream for All. But for some reason, they didn't. Maybe it was because they forgot. Maybe it's because they didn't know how to do it. Maybe it's because they're looking at the world as a nail and all they have is a hammer. So they're just trying to do this one thing. So I don't know. I mean, I don't even know who this loan officer is. But what I am saying is these programs, depending on your situation, could be really amazing or even daunting. I mean, the first scenario they got, they were like, how on earth are we going to pay off $150,000 and call this house ours and not have shared appreciation with California in the foreseeable future? I'm sure is going to happen in their lifetime. I don't know. I do not know. It's a very, very daunting experience for them. But here's the good news. They're on the right path. They talked to the right loan officer. We got them squared away. They're shopping this weekend, which is pretty darn amazing. Okay. So I'm very happy for them. Now let's talk about another program. Okay. Let's talk about another one. Down payment assistance. Okay. Not a silent second. And not a grant. This one's pretty darn amazing too. I really like this program. And here's why. So for down payment assistance programs, you have restricted debt to income ratios. So what that means is as we put a file together, there's a ceiling of where all your debt can hit. Okay. I'm trying to do this so my face isn't covered. So what that means is here's your credit card payments. Here's your car payments. Here's your student loans. Here's your mortgage. And as long as you're under this line, you qualify technically. I say technically because you still need credit and assets and all that other stuff. But just talking about debt to income ratio, as long as all your debts that you pay to a bank every single month are below this line, you qualify. Okay. You qualify. Now, this is traditional, let's just say. So I'm doing traditional financing, which means I'm paying my own down payment. When you pay your own down payment, you have the ability to have more buying power because the debt to income ratio is higher. When you go with down payment assistance, that debt to income ratio is much lower, which means you have to reduce your debts. And how do you reduce your debts when you're shopping for a house? You have to shop for a much cheaper house. Okay. So let me break this down for you. Let's say that traditionally you qualify for a $500,000 house because your income's enough and you, with all your debts added in, max debt to income ratio, you can buy a $500,000 house. But now you're like, I want that down payment assistance program. Like, cool, let me flip it. Let me see how it irons out. Now you qualify for a $380,000 house. So your purchase price dropped way down. And what that could mean is you're not in the same neighborhood that you thought you were going to be in. You may not even be in the same city. You may not even be in the same county. $120,000 purchase price difference is pretty dramatic, depending. Okay. So Why this other one is pretty darn amazing is because it leaves you at your max debt to income ratio. So when you use this program, it doesn't force you to go with a lower debt to income ratio. It leaves it the same. Okay. And the way they're able to accomplish this is that you're actually factoring in a monthly payment for, what is it? I think 10 years. So for the first 10 years, you're included in your total mortgage payment is you're paying back that second loan. So that $15,000 that I keep bringing up, you have a small monthly payment that's included in your total monthly payment to pay back that loan, and it takes you about 10 years. After that 10 years, the loan is paid for, and you keep moving forward with the rest of your loan that you need to pay, okay? And the reason why that's amazing is because of the debt to income ratio situation. It doesn't make you, it doesn't force you down to a lower purchase price. So if you did want to buy in that $500,000 neighborhood, providing when we put in that monthly payment for the first 10 years, you still qualify for 500 grand, then you're in the same neighborhood. You don't have to move, communities, cities, counties, whatever, however far you need to go to get that $380,000. So that one's pretty darn amazing too. So the very first one that I covered was the grant, which means as long as you live in the house for a certain amount of time, it is paid off. The second one that I covered is a silent second, which means that it's kind of just in the background until you decide to make a move with selling or refinancing, and then it shows its face. And the third one I explained to you, you're going to make a monthly payment from the very beginning, and it will get paid off in 10 years. So all of those have their own specific guidelines, and more importantly, they have their more specific reason to be used by an individual or a family. Not everything is a nail and not everything is a hammer. There is a variety of different loan programs out there, even when it comes to something super specific like down payment assistance. So don't get tied up in all the this one's better, that one's better, or the loan officers on social media talking about this one sucks and this one's horrible, because that's not a thing. That's not a thing. Once again, guys, when it comes to finance, there's no good or bad, right or wrong. It's either appropriate for you or not appropriate for you. I've been talking this whole time. My coffee got cold. So yeah, down payment assistance programs, we have them on lock, guys. We have them on lock. We know them. We work with them. We can help you across the country. So regardless of what state you're in, our bank is licensed there. We work with a national big mortgage company, and that's why we're able to accomplish this. Are there programs like this in different states? Yeah, there are. There are. So when you reach out to us, let us know where you're at so we can dive in and figure out what's going to make the most sense for your area. Now, when you start doing your own research, it's extremely confusing because you're going to hear about this program and this city program and that county program and that state program and this federal program, blah, 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 blah. There's so much out there that you're going to lose your mind. And then what you're going to do is you're going to find one that goes, this is the one that I want, and this is the one that I have to have, and this is the only way I'm going to buy a house. And it's not offered in your area. The internet has a lot of data. It also has a great way of having too much data that will mess you up. So it's my recommendation that you give your loan officer a call, talk to them about the programs, talk to them about your goal, talk to them about what you're trying to accomplish, and let us put it together for you. Let us do the research for you. Let us make sure that we cross the T's and dot the I's and guide you properly, because that's our job. So know this, guys, when you hire a loan officer or a real estate agent, you're the boss. You hired them. When someone comes to me and says, hey, I was referred to you to get pre-qualified, I saw you on social media and I thought you knew what you were talking about and I want to work with you, you're simultaneously my boss. You have hired me to provide a service to you to help your dreams come true. You're the boss, okay? So that's why I never say right or wrong, good or bad. It's either appropriate for you or not appropriate for you, and no one knows that better than you. And if you said, Chris, I want that one, damn it, and I would say, yes, sir, absolutely, that's what you get, or yes, ma'am, or absolutely, let's move forward with it. So know that, okay, guys? This isn't a situation of where loan officers are in the seat of control. It's you, it's your house, it's your future, it's your life. And I hope to be a part of it somewhere down there. So if you're interested in getting a home loan, give us a call. Phone number is 909-841-3058. I look forward to helping you. I hope you have a great rest of your week and have a good one. We will talk soon. Take care. Bye-bye.